My next guest, let's dig a little further into the regionals. Chris Marinac of Janney Montgomery Scott is here. He covers the regional banks, and he's not sure that Moody's rating actions were warranted when it comes to putting these banks on credit watch negative. Chris, it's great to have you back. And explain to us, you just heard what Anna said there. How would you differ from her in these concerns about commercial real estate and so forth?
Well, I think the banks have been building reserves for 4 years. Back in 2020, we had reserves go very strongly, and we've continued to grow in 23 and particularly in 24. I think Moody's news is really old. I don't think anything has changed on real estate. I think the banks have already been setting aside major reserves for office, and they'll continue to do so. And the rest of the CRE portfolios are actually acting really well. You have a little bit of slow lease up on multifamily in certain parts of the country. Even multifamily in New York City, I think, is better than advertised because occupancy is very high there. Just the rent growth has been limited.
So we listed some of the names they're most concerned about. Are those names that you think are a buy, or would you share the concerns about those names and be looking elsewhere in the space?
I think commercial real estate concentration has been the issue. The names that have been raised by Moody's really don't have any significant concentration on real estate. I think they've actually been working down their concentration in the past 3 or 4 years. So again, I think Moody's has taken the same narrative and being negative on CRE as a global comment and not really drilling down. What we keep coming back to is the profitability of these banks, the pre-tax, pre-provision or PPNR is very strong. That's going to be a central part of the Fed stress test this month. We think all the large banks are going to pass the stress test. We think some modest changes to capital distributions and dividend increases can occur. I think it's a better second quarter than Moody's is articulating. So I think the banks can really earn their way out of the risk that exists on office, which I think is a lot less than they portray. If you look at what banks actually hold in the system, it's less than 5% of all office. The office exposure is much greater in the private shadow banking world, insurance companies, funds, et cetera. That's really where the risk is. The banks are addressing have been growing reserves, particularly in office, the past 3 or 4 quarters. So I think they're ahead of where Moody's says they are.
So one of the let's say that they might still want to be making some moves. She suggested maybe disposing of assets or partnering with private credit. Sheila Bair, I don't know if you caught this, was on Squawk Box this morning to weigh in on whether there should be more consolidation. Take a quick listen.
We have a lot of regional banks. It's highly competitive, but they need scale to compete. And if you want a market-driven solution to some of this concentration, you need to let the regional banks get a bit bigger. And also, regional bank M&A is important from a stability standpoint, especially when you get into times of stress.
Is that something you're hearing chatter about?
Oh, there's a lot of chatter on M&A. The question is, it's taken a lot longer for the Fed and OCC and FDIC to approve transactions. We're hopeful that it's going to speed up. That would certainly accelerate. I think there is interest in seeing M&A consolidation. Even if investors don't like the deals up front, they tend to like the idea that it creates new opportunities for everyone around them. There's a lot of cost savings that can accrue. So what Sheila's saying makes sense. We just have to have the regulatory agencies kind of abide by a standard of, faster approval process, which it's become very slow the last 2 years.
Quick final word. Which are your favorite stocks in the space right now? And I don't know how much of this is really a waiting game that depends on the Fed.
Sure. Well, it's a waiting game in terms of what the Fed does the next couple of months. But I think even the stress test this month is going to give us a roadmap to how to think about credit quality. Companies like Fifth Third and First Citizens and Wintrust, even Synovus and moving down to Ameris and others, I think you have a lot of capacity to earn through this cycle with strong PPNR that continues to allow the recognition of credit risk. There's no doubt that there's credit risk, whether it's office or other parts of CRE. I just think the banks can handle this no different than if the weather were changing in the months ahead.
Chris, thanks for your time today and reassuring words, I think, for a lot of bank investors and depositors, too, maybe. Chris Marinac of Janney Montgomery Scott.